Hello everybody, so I have a very different video for you today, and it's a video about LEAPS, about call options. So you may know that for 2024 I'm trying to build a little bit of a call options portfolio to capitalize on the hyper growth that I see coming over the next 2 years, and capitalize really on that drop in rates over the next 2 years. And options are really a way to do that, especially for me, because I plan on converting these options into stocks 2 years from now. Options are a great way to increase your exposure on the stock market without having to put as much money as buying the stock outright, right? That's what call options are originally for. That's what they've always existed for. Of course, people trade them nowadays, but initially you're just buying the right to buy a stock at a strike price in the future. You're buying that right. You're paying for that right to buy that stock at strike price in the future. And these are called LEAPS because they are long-term, right? Whenever a call option is a long-term call option, like a 2-year call option, that's called a LEAPS. So this is a list of all of the January 16, 2026 call options on my favorite hyper growth names, the stocks that I believe will do very well, and the stocks that I've covered multiple times on the channel. And this is the kind of a new spreadsheet that I've been working on this evening, where I'm trying to find a way to assess how much money each of these stocks that I'm bullish on is going to immobilize, right? Is going to take away. And so let me explain briefly the spreadsheet. So these are LEAPS. These give me the right to buy on January 16, 2026, the right to buy each of these stock at the indicated strike price. So for example, for On running shoes, that would give me the right to buy the stock for $25 a share. I would buy the right to buy the stock for $25 a share at a price of $8.77. That's what it would cost me for the right to buy one share at $25. But I can't use the option price because the stock today is currently trading at $27.49 and the strike is cheaper. So there is a delta between those two numbers. So really, I'm paying less than that. I am removing that delta because I'm buying the right to buy the stock at a lower price than the stock is currently trading. So I'm getting a $2.50 discount in 2026 compared to the current quote. So that means that the true option price, say for On holdings for the January 16, 2026, the true option price here is the actual option price minus the strike price, the stock price minus the strike. So the real price that I'm paying is $6.28. So $6.28 is the real price that I would be paying, times 100, of course, because option contracts can only be bought by 100. So really, $6.28 is what I would be paying for the right to buy 100 shares of On holdings at $25. What's important here is this number that I've highlighted, which is the cost of the call as a percentage of today's stock price. And so in the case of On holdings, the cost of that call is 20%. And between 22, 23 to say 30-ish, maybe 33, 34% is typically what I've noticed 2 years out call options trade at right now. So as you can see, most of them in this spreadsheet are at pretty decent price, but I've detected some anomalies. So, and by the way, these are at the money strike. So I've detected some anomalies. But before I show you the anomalies, let me just show you what I agree with. So I put Colgate. If you follow the channel, you know that I don't invest in Colgate Palmolive. This is a company that only grows at the rate of the economy. The reason why I have Colgate in there is because a quick Google search, I tried to look for the least volatile company in the S&P 500. Turns out the least volatile company in the S&P 500 is Colgate, which they mostly make toothpaste, right? So the market believes that the price of Colgate won't move much 2 years from now. And that's evidenced by the fact that the price hasn't moved much for the past 10 years. It's kind of always trading at the same price, Colgate. And because the market does not anticipate that the price will change at all, Colgate is only, if I want to buy the right to buy Colgate 2 years from now, I'm only paying 8.5% of that stock price. I'm only paying 8.5% of that stock price. And I actually agree with the market here. I don't think Colgate's price is going to change that much within 2 years. So I really have no reason to buy this call, right? There's no, like, I agree with the market. So there is no reason for me to pay someone else's premium and buy that call. There's no reason, because when you buy a call, you're kind of paying someone's retirement or someone's edge. But in the case like Colgate, it's a dividend stock. I'm betting there's some retiree somewhere who's selling long-term calls and just collecting the premium. There's no reason to ever buy that call, in my view, because I don't believe in that stock. I don't believe that company is gonna go up at all. There's another reason where I see no reason to buy a long-term LEAPS. For example, Let's take Cleanspark, stock I never covered on the channel, but I'm a shareholder. It's a leverage play on Bitcoin because it's a great Bitcoin miner in my view. And when I look at Cleanspark, it's kind of the same scenario but in reverse. There's no reason for me to buy Cleanspark, because if I wanted to buy Cleanspark in the form of a LEAPS, I would need to immobilize 54% of the stock values today for the privilege of buying Cleanspark at $7.50 a share in January 16, 2026. That makes very little sense. You don't even get a 2x leverage on this. It makes little sense to me to take that risk. In that situation, right? Given the big premium, 54% of the price for a privilege of getting the stock at the strike in the future, at the strike price in the future. In that situation, I'd be much better off buying the stock, right? And I would want to buy the stock, and I would argue you would be much better off buying a stock that's that expensive on a call option basis. You'd be much better off buying that stock outright and then do a little margin on it, right? Borrow with a little margin if leverage is what you want, because call options is what they are, but they give you leverage. So if you want leverage, just buy the stock outright because it's a very expensive stock, and then I would do a little margin on it. No investment advice, no financial advice, but that's just how I would look at it. So I agree with the market here too. So I agree with the market on Colgate, would not want to buy. I agree with the market on Cleanspark, would not want to buy. Most of these other stocks, when I look at this metric, is more of a meh, like it more depends on my conviction on the stock. Like for example, Tesla, I'm perfectly fine paying 27% to buy that right, to buy 100 shares of Tesla. I'm perfectly fine. I think it's a decently priced stock because I think that stock's gonna skyrocket. If I look at companies like, I don't know, ENPH, I think ENPH is a little pricey. I'd rather buy the stock. But what about anomalies like this one? So let's talk about Nubank. So Nubank, yes, Nubank has had very little volatility over the past 10 to 11 months, sure, but this is still an anomaly in my view that I can get Nubank for 15.9% of I can get the right to buy Nubank 2 years from now and hold the price roughly steady for only 15.9% of today's stock price. So in other words, this is abnormally cheap in my view, in the case of Nubank, for a company that is predicted to grow revenue at 85% next 12 months. And then with a large number kicking in, maybe they'll do 70% in 2025. Right? But if you look at the price, the amount of money that one needs to immobilize in order to buy the right to buy Nubank 2 years from now at a price of $7, right? To buy that right, you need to immobilize 15.9% of what it would cost you to buy the shares today, right? And I feel like there's a tremendous potential that this stock is going to do much better. Another way to put it is that the cost of buying a Nubank option, LEAPS, buying the January 2026 Nubank LEAPS, that cost for that LEAPS on a hyper-growth company is barely 2 times the cost of the LEAPS on a Colgate. On a Colgate, which is a toothpaste company predicted to grow at 5% the rate of the economy, no more. So you have a company who's going to grow 15 times, easily 15 times faster in a single year, by the way, not even 2 years. Over 2 years, probably closer to like 25 times more. You have a company that's going to grow 25 times more than Colgate Palmolive, but the cost of the LEAPS call option is not even twice as much. So it seems to me when I look at this, like some LEAPS are very attractively priced. And namely, I see Nubank as an attractively priced LEAPS, but I also see, compared to my expectations of the potential of these companies, I see HIMS at 23% of their structures as really attractive, and I see ON Holdings also as very attractive. Does that make sense what I'm saying? So this is of course this is a work in progress. This is me thinking out loud. I'd love to hear what you have to say in the comments section. But to me, it seems like a good way to spot anomalies in options pricing. So hopefully you can tell me what you think about this in the comment section. I realize very different video today, but I'm excited to hear your thoughts. And thank you so much for watching. This was not investment advice, right? This is no financial advice, just entertainment. Hoping you were entertained. Please like, please subscribe, and have a wonderful day. Thanks for watching.